Welcome, everybody. I'm Emily Gansert with the Georgia Center for Nonprofits, and today we are here to look at PPP loan forgiveness. We're so thankful to our partners at Aprio for bringing this topic to us and walking you through what that process is going to look like, what the requirements are. So with that, let me hand it over and introduce Tom Curran and Justin Alanjan, and they are going to run our show today. Welcome, Justin.
Thanks for joining us as we talk about the Paycheck Protection Program. We're focusing obviously on loan forgiveness at this particular point in time, and we're going to focus specifically on the applicability to not-for-profit organizations. Fortunately, what that means for us is we can remove any discussion around owners' compensation, which can certainly get unnecessarily complicated for some businesses. On our agenda today, we are going to start with what we call the PPP forgiveness overview. What this really does is focus on a couple of key criteria, key terms to keep in mind that we're going to reference throughout the course of today's presentation. We'll then dive into the details of what we call covered costs. Those are the costs that are eligible for forgiveness. In fact, those are the only eligible uses of your PPP funds. We'll break that down between payroll costs and non-payroll costs and what qualifies, as well as some of the items that we see come up and questions that arise for things that don't. Unfortunately, there are some situations that could come about that could cause a reduction in loan forgiveness. Really important that we talk about what those are, as well as the associated safe harbors that are available. And then we'll dive into some of the specifics on the timing of loan forgiveness, as well as the associated terms of your PPP loan, as at the end of the day, it is a loan, it just happens to be forgivable. It's important to note that as we go throughout the course of this discussion, substantially everything we're going to talk about here applies exactly the same to PPP round 1 or PPP round 2, whether that loan was obtained in 2020 or 2021. There are a few very specific exceptions. We'll tag some dates, we'll call attention to them as they arise. But as we think about things like a covered period, as we think about covered costs, those are exactly the same for your round 1 or round 2 funding. As Emily mentioned, I'll work through this quickly here. Today, joining me will be Tom Curran, who's a member of our PPP and our ERC team. We are focusing today on PPP, but I'm sure somewhere along the lines we'll throw a mention about the employee retention credit in there. My name is Justin Alanjan. I lead our PPP and ERC service team here at Aprio. For those of you that may not be familiar with Aprio, we are a CPA-led business advisory firm headquartered in Atlanta, Georgia, but have offices up and down the East Coast, and employees like our clients are across the country. In fact, Tom is out in Colorado. We have clients in all 50 states and over 50 countries around the globe. But here we mentioned CPA-led business advisory, which is a very intentional term for us here at Aprio. While we certainly support and service compliance-related matters as we think about audits, we think about tax returns, it's our 24 specialty services that really allow us to support businesses in achieving their business objectives and whatever their next may be, whether that's scaling up or winding down. Aprio is here to support a business holistically. And that's a lot of how we got into the Paycheck Protection Program services and supporting our clients in going through this effort. In fact, my involvement came directly in supporting independent schools here in the metro Atlanta area. One thing has led to another, and here we are about 15 or 16 months later, still talking about the Paycheck Protection Program. That all being said, let's kind of get into the details here and what we have in front of us. Tom, always good to have you with me as we go through these webinars. This is always the time I like to turn it over to you to talk about one of the most important terms throughout this entire program, the covered period.
Thanks a lot, Justin. Happy to be here with everyone today and talking about this important topic. So kind of the first thing that you want to think about in terms of your PPP loan is, what is your cover period? And the cover period really means the eligible time that you have to spend your PPP loan proceeds on eligible covered costs. When does it begin? Well, it begins on the date of your loan disbursement. So you'll check your bank statement, see when the loan proceeds hit your bank account, and that's going to be the beginning of your cover period. Then on the end of it, you ask yourself, when does it end? Well, this has changed and evolved over time. So if you're an individual that may have already applied and received PPP loan forgiveness on your round 1 PPP loan, and you're getting ready to start the process again on PPP loan 2, this is an area that may have changed since you did your first loan. So as it stands today with the Consolidated Appropriations Act that passed back in late December, which feels like almost a year ago now, it added additional flexibility to the cover period. So now the cover period ends any time between 8 and 24 weeks. It used to be you had to pick either 8 weeks or 24 weeks. And now you have the ability to customize your cover period. And in customizing it, really the reason is to offer you flexibility. So if you only need 12 weeks to receive full loan forgiveness, you don't have to worry about the last 12 weeks of documenting the expenses that you spent during that time period for loan forgiveness. It really is about flexibility and easing the documentation burden on you if your specific situation allows you to reach loan forgiveness faster than 24 weeks. Has to be 8 and can be anything up to 24 weeks, but it's really meant for flexibility. The other piece that I'd like to mention here to everyone is if you were doing your first loan, there was an alternative payroll cover period. That's no longer an option to use. You have to start your cover period on the date that you received your loan disbursement.
Yeah, Tom, this is one of the things that has certainly come into play for a variety of strategic decisions. I think often as we go through this, the question always comes up from a business about what covered period should they use. I'd love to give it a better answer than it depends, but it's certainly the most appropriate one here. Based on what's happened with your workforce, based on when you spent all of your funds, are you utilizing and taking advantage of the employee retention credit? Just a few of the factors to consider when evaluating the covered period and what's most appropriate, noting that we do have the opportunity to select any whole number of weeks between 8 and 24 from the date in which you received your PPP funds. Again, that covered period always begins the date you received your funds, but you get to choose the end of your covered period between 8 and 24 weeks from that date, the selection of which takes place when you actually submit your loan forgiveness application. And Tom, the other thing that we have seen here is an expansion in covered costs, just like we saw a change with a covered period and how that's defined. I want to reiterate as we look at this list, because it's certainly different than what we saw throughout the course of 2020, that these costs apply to all PPP loans. This was a retroactive change, a change to the Paycheck Protection Program, not just those loans originated in 2021. And this change came about on December 27th as part of the signing of the Consolidated Appropriations Act, where they added an additional allotment of funding, which was dispersed throughout the early part of 2021. What we really see here is an expansion in non-payroll costs. And this is how we're going to break down our presentation. We have our payroll costs, which we split between cash compensation and non-cash compensation. And then we have our non-payroll costs. These first three are kind of what we would refer to as our legacy non-payroll costs: mortgage interest, rent, and utilities. We've had that since the program began. But then on December 27th, again, a retroactive change was made to the program in which they added operations expenditures, property damage costs, supplier costs, and worker protection expenditures. Hang tight, I promise you, we will define each of these and provide some examples as we go throughout the upcoming slides in today's presentation. Tom, the other thing to consider with covered costs, and I think we head this one off right in the beginning, which is extremely important as we're thinking about the covered period, is the timing of those associated costs. When do they need to be paid? When do they need to be incurred in order to be eligible? Can you talk us through this one a little bit?
Yeah, absolutely, Justin. And you hit the nail on the head right there, talking about paid or incurred. It's really, as you notice on this slide, there's a word that's capitalized in bold. It's or. So this isn't an and test, this is an or test. So the first piece that's eligible is any payroll and non-payroll eligible costs that were paid during the cover period are eligible for loan forgiveness. The second piece is if they were incurred during the cover period, but paid after the cover period by the next regularly scheduled billing cycle, payroll or billing cycle. So what we think about there is if you have an expense that you know you spent during the period, but you paid it normally, paid it on its next regularly scheduled cycle after your cover period ends, those costs are also eligible for payroll to be included in your PPP loan forgiveness application. They have to be paid on time though, so it's not something that you could skip 2 months and go back and say, oh, I need these for loan forgiveness. They do have to be paid on time, so they can't be past due. But it gives you a little bit of flexibility to gather some additional expenses at the end of the cover period that you wouldn't be able to if it was an AND test.
Yeah, Tom, this is an important change to just reiterate, provide a quick example here. As we look at paid, always start there. Was it paid during the covered period? If the answer is yes, odds are it is going to qualify for loan forgiveness. There are a few specific exceptions in which we can't prepay certain costs. We're going to call attention to those as we go. So if you received your PPP funds on, let's say, a Wednesday, that's a middle of a payroll cycle, and the payroll set to pay out that Friday, right? 2 days after you received your funds. Despite the fact that substantially all of that payroll cycle was incurred before you received your PPP funds, before your covered period, all of that can be included as an eligible cost in your forgiveness request because it was paid during the covered period. Incurred really comes into play on the back end of your covered period as you think about the fact that when we look at utilities, you look at mortgage interest, we look at payroll, a lot of these costs are paid in arrears. So let's, today's September 1st, usually probably not the best day to use that one. Let's say today was the end of our covered period, September 1, and we have a utility bill for the month of August. We haven't received the bill yet. When we do, and we pay it, let's say on September 15th, because of the fact that all of the month of August was during our covered period, we can still include the entire bill in our forgiveness request, even though it's going to be paid after the end of your covered period. I don't know that we see that as much anymore, Tom, with having 24 weeks, but it's still important for those that are selecting a covered period, something other than a 24-week duration. Let's shift gears here into payroll costs. First and foremost, this is really important. This may be all of your PPP loan, but certainly it's going to be the lion's share. We'll talk about why I say that as we go through the course of discussion. First and foremost, Tom, let's start with cash compensation. This is the most intuitive, but certainly important to remind everybody what qualifies under the program.
Yeah, absolutely, Justin. I'm glad that you bring up that point right away too on the thought that maybe your entire PPP loan is forgiven through payroll costs. We'll get into the specifics on other costs later on, but for many of you, you may be able to accomplish full loan forgiveness with just payroll costs only. So in terms of payroll costs, what can you include? So cash compensation in the form of gross salary, wages, bonuses, commissions, tips, or anything that's similar to that compensation can be included. Any payment for vacation, family, medical, or sick leave, with a couple of exceptions. If you received FFCRA credits, those aren't eligible, but anything that's vacation, family, medical, sick leave, others is included. Any allowance for separation or severance payments that you have, it can all be included for loan forgiveness. All right, great. So the limits on cash compensation. What type of limitations do you have? It's limited to $100,000. It's prorated over your cover period. So in terms of cash compensation, basically what you have to do is you have to take $100,000, divide it by 52, and multiply it by the number of weeks that are in the cover period. So when you work that out on a 24-week cover period, it works out to $46,154. Anything, if you choose something less, 8 weeks to week 23, you have to do the math of basically 100,000 divided by 52 times the number of weeks in the cover period. And this is going to apply to any employee that you have that makes over $100,000 in the cover period. Next, on to payroll costs. What about non-cash compensation that we can include in your loan forgiveness? So, employer's portion of group healthcare coverage is available. Employer's portion of retirement benefits, and any state and local taxes on compensation can all be included as non-cash compensation. Retirement benefits and group healthcare benefits that were accelerated from periods outside the cover period are not eligible for loan forgiveness. So you aren't able to prorate anything or prepay it for loan forgiveness. Anything that you do in that standpoint, you'd have to ultimately end up not using for loan forgiveness. Also important to note, this is a kind of a caveat, that non-cash compensation, it's not subject to the $100,000 limitation that we discussed earlier on cash compensation. So payroll costs, there are some exclusions that we have to also work through. First, we've already kind of covered. It's any cash compensation in excess of $100,000 can't be used for loan forgiveness. The second piece is any compensation for an employee whose principal place of residence is outside the U.S. So if you have an employee that doesn't live in the U.S., their wages are not going to be eligible for loan forgiveness. Any payment that you made to independent contractors isn't allowed. The rationale for that is all independent contractors are actually eligible for their own PPP loan. So therefore, in order double dipping the wages for loan forgiveness, you can't use independent contractors. It's only W-2 wages. Any payments, and we touched on this briefly, that were paid via the Family First Coronavirus Response Act, FFCRA credits, need to be excluded. It's, again, the double dipping principle. And then the final one that Justin mentioned earlier in today's call is any qualified wages that you use to determine the employee retention credit, you're not able to use for PPP. So you have to make sure that both programs are separated. It's really, at the end of the day, they don't want you to be able to use wages that you used for one program for one of the others. So there's just no double dipping allowed. Next, we're going to move on to non-payroll costs. And as we talked about earlier, this bucket has evolved over time, and the program has matured and been changed through subsequent legislation. So the first piece that we'd like to go through is what utilities. What type of utilities are you able to use for PPP loan forgiveness? So electricity, gas, water, phone, internet, and then the last one, transportation. I do like to point that out on these talks, because it's not what you would think. It's not gas, it's not fuel, it's not oil. It's actually tolls. So anything that you might have incurred in terms of transportation to and from locations where you would incur a toll, the tolls are eligible for loan forgiveness. Unfortunately, you can't take your entire gasoline bill and throw it towards forgiveness, but if you had to pay a toll to get from point A to point B, that can be eligible for loan forgiveness. Up next is rent. And rent, we're going to go through rent and leases separately, but you're going to notice some common themes with both of them. So first off, with rent, if any business or rent lease payments that were pursuant to lease agreements that were in place before February 15th, 2020. So unfortunately, if you entered into a lease after February 15th, 2020, it doesn't apply for this, with one exception. If you did have a lease that existed prior to February 15th, but it ultimately ended up expiring on or after February 15th, 2020, and that lease was renewed, those lease payments are eligible for loan forgiveness. So if you renew a lease, it's eligible, but if you ended up moving to a subsequent new property, that would be considered a new lease that wouldn't be eligible for loan forgiveness. So there's a big difference between renewed and new lease in this situation. It's also important to note that rent is inclusive of payments for both real property and business use personal property. So, whether it's a copier or it's your actual physical space, a lease is a lease in that standpoint and can be used for loan forgiveness.
Yeah, Tom, I think that's one of those areas that we see being often misunderstood, is that business rent is specific to square footage. or physical space, right? When we think about that for business use personal property, that may be equipment, that may be furniture, that may be vehicles. It really depends on obviously what's applicable to the business and to determine what type of personal property may be able to be utilized. To keep in mind here, it's business use is a requirement here when we think about the personal property aspect, but definitely important to note that it is not just square footage. It's not just a building. It's not real estate specific.
Great. On to interest payments as well. Like I said, we're gonna see some common themes here with similar to rent. So payments of interest, excluding principal payments. So it's interest only, no principal payments or prepayments of principal. It's interest only on any mortgage obligation on real or personal property that was in place prior to February 15th, 2020 is eligible for loan forgiveness. Similarly to rent, if that mortgage or loan was refinanced after February 15th, 2020, that interest can be included for loan forgiveness. But if you went out and got a completely new loan, that loan after February 15th, 2020, that mortgage interest would not be eligible. So little nuances there. It's also important to notice that non-mortgage interest is permissible use of PPP funds, but it's not eligible for loan forgiveness. So what we say by that is, say you ended up using your PPP loan proceeds to pay a credit card. That's okay to do that. You just can't include those credit card payments in your loan forgiveness because it isn't mortgage interest. Justin, over to you to talk about the what we commonly refer to as the new bucket of PPP loan forgiveness covered expenses.
Sure, thanks, Tom. And as a reminder, as we go through the more recent additions to the program, all things being relative, these costs that we're going to cover do apply to 2020 PPP loans. It is not just utilized for 2021, should that be applicable to the business. Covered operations expenditures. This is the first one that we see here. Really broad terminology. Frankly, it is kind of broad when you think about its applicability here within the program, with one caveat that's super important. We're talking about software. Software or cloud computing services that facilitate operations. And that can take you down a whole lot of different directions and paths here as we think about product or service delivery. We think about accounting, again, software. We think about human resource functions, billing, sales, inventory, shipping. A lot of different options that may come into play. I've named a few. I would imagine in this particular group, you think about donor platforms and donor management platforms coming into place, how we're tracking that, and any other services that we may use for tracking usage of grant funds and associated costs. All of those are coming into play here when we think about covered operations expenditure. Again, broad category, noting that we are focusing on business software or cloud computing services that facilitate business operations. What we'll see with this cost, as well as the subsequent costs we're going to address in non-payroll, unlike what we had throughout the course of 2020, which was a release of a frequently asked question document or an interim final rule about twice a week, we've seen very little in 2021. In fact, there's been zero FAQs put out to provide further clarity on covered operations expenditures or these next three non-payroll costs we're going to discuss. So we do obviously need to use some discretion and judgment in applying those and utilizing those in our forgiveness request. But feel free to ask questions throughout the course of the presentation, and we'll use a couple of examples as we continue to describe these. So I'm taking a look next at covered property damage costs. This one's a little bit more particular from a timing standpoint, despite the fact that this can be used for either 2020 or 2021 PPP loans. The time period for which this cost relates is very particular. This isn't any property damage. This is property damage, one that was not covered by insurance or any other similar type of compensation, and two, that was related to the public disturbances that occurred during 2020. If we think back about June or July of 2020. Unfortunately, there was a bit of civil unrest, and there was a lot of vandalism, a lot of looting, a lot of damaged storefronts and other facilities. That's what this is talking about here, is utilizing those unreimbursed or uncovered costs can be applied towards your Paycheck Protection Program. But it is, again, specific to those activities and public disturbances that occurred during 2020. Next one, you have gives a little bit of a sense of a theme here on how the SBA has more broadly applied some of these costs, really increasing opportunity for forgiveness for those that could not get there with payroll. Covered supplier costs. A couple of really important things to keep in mind from a timing standpoint and a qualification standpoint if we're going down this path. A covered supplier cost is an expenditure made by a borrower to a supplier of goods. Here's the criteria we need to focus on. One is that the goods are associated with a purchase order or a contract or something of this sort that was in place before you received your PPP loan, before the covered period began, right? I made my order, I entered into that contract before I got my PPP funds and then paid it during my covered period. Now that may be different if what we're talking about is perishable goods. I think there's probably, if I saw the list correctly, there's probably a few of you here in the audience today in which perishable goods are going to come into play here. Again, this is about purchasing, not donation, but for those that have perishable goods that are purchasing these items, a little bit different. Fortunately, they're not looking at old orders and subsequent payments, meaning these perishable goods may have been sitting for 6 months. We get the opportunity to include orders before your covered period or any time during your covered period. So big change there for perishable goods. A lot more particular for those that are dealing with those as it relates to opportunities for utilizing these costs. But irrespective of when the purchase order took place, it's important not to overlook this one aspect that applies to both perishable goods and non, that the goods in question are essential to the operations of the borrower at the time the expenditure is made, right? When we make the payment, do we really have to have a need for that good? Was it essential to the business and how I conduct my operations at that time? In many cases, I think that's probably by default. That's a yes. Why would I pay for it? Why would I buy it at that time? Of course, it relates to a contract or an order you placed previously. So there certainly may be some exceptions that come into play, but keeping in mind that if it's a non-perishable good, it's an order placed before you received your PPP funds, and it's essential to the operations of the borrower at the time in which you write the check or make the payment. Last but not least, Tom, we've got worker protection expenditures. All of us can relate to this. Whether or not we have it, another story. Worker protection expenditures is any operating or capital expenditure, for those accountants out there in the room, operating or capital expenditures to facilitate the adaptation of the business and its activities to be able to comply with recommendations and requirements for COVID. Been just a few of those that have been put into play over the last year and a half. But this can look at a lot of different components as we think about purchase, maintenance, renovation of assets, expansion of footprints, whether that has to do with indoor facilities, outdoor facilities. We're seeing a lot of entities that have bricks and mortar replacing HVAC units or other filtration systems. We've certainly all seen plexiglass, right, to accommodate social distancing. Health screening capabilities, if we're doing temperature checks or other things of that nature. All of that's included in worker protection expenditures. But it doesn't even stop there. We can even look further down into the details as we think about certain types of materials, think about face masks, think about gloves. I would probably go as far as to say hand sanitizer could be included if we're talking about complying with sanitation requirements and other COVID safety measures. like these other costs and really all the costs within the program, it's important to ensure that these are for business use, not personal use, when including them in a forgiveness request. So Tom, our last component here when we think about non-payroll costs, and I'll probably dive into just some specifics where this may come about, has to do with some limitations that have been placed specifically on non-payroll costs. What we see here, and we'll break down these bullets into a couple of segments. The first piece of the first bullet is about operations of a tenant or a subtenant. And what it says is we can't use those costs in our forgiveness application if they're not attributable to our business. So as an example, let's say that I've got an office lease. I've got 2 floors in my building that I'm renting. And through COVID, I didn't need all the space anymore. My employees wanted to stay remote. But Tom was on the other end of the spectrum and was looking for a facility. And instead of renting one on his own, we entered into a sublease agreement, and now he occupies 1 floor and I occupy 1 floor. From that point forward, I cannot take the entire amount of rent that I'm paying the landlord included in my forgiveness request, as I'm only occupying 50% of the space, right? 50% of that payment I'm making to the landlord is actually attributable to Tom's business. So you have to look at that if you've got tenants or subtenants that may come into play. That's, again, I'm using rent as the example there, but that would apply the same if we had CAM, if we had other utilities or things that were covered as non-payroll costs that could be attributable to a tenant or a subtenant. I don't know that we see a lot, but I'll certainly point it out. We think about home-based businesses and household expenses. The key item here, and I made this comment as we were flipping into the slide, is ensuring that we can document and support the fact that it's for business use if we're including it on a forgiveness request for a business PPP loan. To make sure that we can document it and delineate that appropriately when utilizing those costs. This next one, I know that we see in the not-for-profit sector. When we look at related party rent, this one is specific. We're talking about rent and lease payments here. If we have a related party and we've entered into a lease agreement with the related party, we may be able to still include some of those rent payments in our forgiveness request as the lessee, only to the extent that the property owner has a mortgage on that property, and up to the extent of the interest, the mortgage interest that they incur over your covered period. Unfortunately, what that does mean is if we have a related party rental agreement and the property owner has no mortgage at all, they have no interest, and therefore we can't use any of that rent in our forgiveness request. Areas where we certainly see this as we think about religious schools, right there, there's a lot of times where the property or part of that property or a preschool or something of the sort is actually owned by the church, or sometimes the entire school, the property is owned by the church. And we enter into a lease agreement between the two. If we're deemed to be a related party, and I'm not going to spend a lot of time in today's conversation going down that path, but via common board members and control, then we may find ourselves in this situation. And depending on whether or not there's a mortgage associated on that property, we may or may not be able to include those rent payments. So it's just something to keep in mind as we think about this and utilizing some of these costs. It's also a good reminder as we think about this program that we have a variety of documentation requirements. No matter how big your PPP loan is, you have a documentation requirement. No matter which application you're using, you've got a documentation requirement. They just differ. So depending on what costs we use, what application we're using, we may be faced with different documentation requirements. And they're broken down and frankly just listed on the instructions on the PPP loan forgiveness applications, but they're broken down between costs or documents that are borrowers required to submit. And what that's suggesting is submit to the bank when we apply for loan forgiveness. And I guess now maybe the SBA with this direct forgiveness effort. And then there's the documents that we must maintain. So understand what's there and what our requirements are. Make sure that we have all those on hand. Really, really important. We've seen the SBA come back of loans as small as $20,000 and put them under loan review. They're doing a random loan review based on a series of analytics that they're running in their systems. And they can request, and you'll see one of those caveats in the documents you must maintain, pretty much anything that they deem relevant. So make sure that we have our documentation requirements met, whether or not we have to submit any to a bank or we have to maintain them. Think about what's applicable to your loan and your fact pattern and make sure you have those on hand. Loans greater than $150,000 have a 6-year document retention policy from the date in which the loan has been repaid or forgiven. So conceivably, this could come back up 3, 4, 5, 6 years down the road. Sure hope not, as I'm sure many of you don't as well. But to be safe, make sure that you have and understand your documents together. Make sure you understand your documentation requirements. I bring all that up on this particular slide because this would be burdensome. And if I can get to forgiveness in some other more simplistic fashion, using different costs, using more payroll, using a longer covered period, I'm going to go that route to minimize the administrative burden relative to the Paycheck Protection Program, provided that I can still achieve full forgiveness in my PPP loan. I guess, Tom, that's a good time to go into when I may not receive full forgiveness on our PPP loan in our forgiveness reduction section next.
Great, Justin. Yeah, going through forgiveness reductions, and I think this is a good point just to pause before we go into forgiveness reductions, because I've seen it in the chat already, Justin, is we just outlined the world that is your oyster in terms of what you could use for loan forgiveness, right? You don't have to use all of this. Really, all you have to end up using at the end of the day is cash compensation if it can get you there. Everything else that we talked about after cash compensation is all if you need it. So it's important to know that we just went through a lot, but you can pick and choose whichever of these items gets you to full loan forgiveness with as little documentation as possible. So while it can be burdensome, there are ways to limit the burden, as Justin alluded to a little bit earlier.
Yeah, and Tom, just to reiterate what you said, and again, coming off of the documentation discussion, non-payroll costs are only required to be submitted if you're requesting forgiveness on those amounts. Really important part of the strategy that you may apply to your forgiveness approach. Obviously, it depends on the facts and circumstances of the business, but note, and we'll talk about this a little bit in factor number 4 here, non-payroll is only required to be reported and then ultimately documented if you're requesting forgiveness on those amounts. That being said, Tom, let's kind of talk through these various factors. I know number 2 and number 3 can be a bit of a bear.
Yeah, absolutely, Justin. And guys, this is the intro slide. We're going to go through each one of these topics in much greater detail over the balance of today's webinar. So high level, factor number 1, unspent loan proceeds. If you didn't spend, it's not eligible for forgiveness. Factor 2 is a full-time equivalent reduction or an FTE reduction that we'll walk you through on how to calculate that. Number 3 is a salary and hourly wage reduction. And it's important to note on factor number 2 and factor number 3, there are safe harbor rules that we'll also walk you through, so that even at the end of the day, if you had an FTE reduction and you had a salary and hourly wage reduction, you still have a path to full loan forgiveness. Not all is lost. We deal with it, I feel sometimes on an hourly basis with clients that had both of these and still are able to receive full loan forgiveness. So not all lost if you had one or the other or both. And then finally, the factor number 4 is the non-payroll expenditures and how you limit your eligible non-payroll expenditures for full loan forgiveness. Justin, you want to talk through the unspent loan proceeds, factor number 1?
Easiest one in the deck. If you don't spend it, you can't get forgiveness on it, right? We have to be able to utilize our funds in order to get forgiveness. So if we have $1 million loan and through all of these costs and both paid and incurred, we only get to $900,000, the most amount of forgiveness we can ever get is $900,000. Plain and simple here, factor number 1, unlike factor number 2, the full-time equivalents. Important to note, just depending on loan size here, as we think about factor number 2, and this also applies to factor number 3 as well. If any of you out there have loans $50,000 or less, just tune out for the next couple of minutes. Factor number 2 and factor number 3 do not apply at all. Unfortunately, for everybody else, $50,001 or above, these do come into play. It's just how you navigate them may very well differ, particularly as we think about safe harbors. Tom, a lot of information here.
Yep.
Let's try to cover this where we can. A couple of decisions to be making when going through FTEs, but let's start by how we calculate them.
Yeah, absolutely, Justin. I think it's also important to note as we walk through this today that your payroll provider in the majority of cases are going to have canned reporting that's going to help you walk through the process that I'm about to talk to. So if you use ADP, Paycom, Paychex, a third-party payroll provider, there's a high likelihood that you're going to be able to go into your payroll system and pull a standardized report that they've developed to help you through this. So first, how do you calculate an FTE? Well, it's important to note that it's done on an individual basis. Okay, so individual by individual. So the specific situation revolving around that specific employee can change as you work through your cover period. So it has to be done on an individual basis. So you start by taking the hours paid per week and divide by 40, round it to the nearest tenth, and it's capped at 1. So you can never have any one that's greater than 1, but you can definitely be less than 1. This is option number 1 for calculating FTE. They do give you 2 options. It's a more complex one, so you're able to choose which benefits you the most. So hours per week divided by 40, rounded to the nearest tenth. Second option is much simpler. Basically what you do is you take a look at your employee count and you label anyone that worked under 40 hours. It doesn't matter if it's 39.9 hours. It just has to be under 40 hours. You can treat that individual as a 0.5. Anyone that would work 40 or more hours in a week, you would be capped at 1. So 40 hours or more, you're a 1, 39.9 and below, you're a 0.5. So that's the option that we see the most of the time, just because it's easier, but depending on your specific situation and your employment trends, you have the ability to choose option 1 or option 2. So then, you ask, what do I do with this data? How do I take a look at this with the FTE reduction quotient? Well, it's average weekly FTEs during your cover period divided by average weekly FTEs during your reference period. So the calculation's the same, but you have 2 measuring points. And we haven't talked yet about the reference period today, so we'll go into it a little deeper here. For your reference period, you have 3 options. Most likely it's going to be option 1 or option 2 in your case. And those options are February 15th, 2019 through June 30th, 2019. Second option is January 1, 2020 through February 29th, 2020. And you ask yourself, why are you using these 2 periods? Well, it's because they're trying to get, the SBA is trying to get a sense of what your business looked like pre-pandemic. And these are the 2 options that you have. The third option, mostly used for seasonal businesses, it's any consecutive 12-week period between February 15th, 2019 and February 15th, 2020. But that only applies for seasonal employees. So once you do all this work and you calculate this, what does it tell you? If your average FTE count during the cover period is lower than it was in your reference period, an adjustment needs to be considered if you do not meet the safe harbors that we're going to go through in future slides. Justin, is there anything you want to add on this one? I know it's a fairly complex topic, probably the most difficult piece in the entire PPP loan forgiveness process.
It certainly can be the most complicated aspect of this as it comes into play. Effectively, what this is doing, did we maintain our workforce? That's the basis of what this is saying. Do we maintain them at appropriate levels as to pre-COVID? A couple of things that we certainly see come up as a reminder, a great time to do it. These reference periods that Tom's talking about, February 15th to June 30th of 2019, January 1 to February 29 of 2020. Not sure we have any seasonal employers here. Those are the same for PPP1 as they are for PPP2. We get that question all the time. They're exactly the same. Again, your choice You make this, you don't really actually officially ever make the election other than you need to report it on a loan forgiveness application. So at least by that point, you need to make a determination. It's important to note as we think about FTEs, we can certainly have the opportunity to actually have enough costs to overcome any forgiveness reductions and still achieve full forgiveness on a PPP loan. But more importantly, Tom, I'm excited to get to the safe harbor to get everybody out of these calculations because it gets really burdensome, can get really complicated. And I've got a bit of an inkling that there's some particular activities that are going to allow many in this audience to utilize a safe harbor. Before we get there, Tom, let's talk about the reduction exceptions, just very briefly, things to keep in mind, because again, we're going to give you some ideas to try to stay clear of this and move forward. Fde reduction exceptions, we saw some of these in particular quite often in 2020. It is important that it follows one of these very four specific, what I like to refer to as triggering events, and they must have occurred during your covered period, right? Offers for rehires that were made in writing and subsequently declined by employees. Unfortunately, we saw a lot of that when with unemployment being as high as it was in 2020. This happened frequently. Employees who leave voluntarily, employees who are fired for cause, right? If an employee leaves voluntarily, we're not going to hold that against the business. The business has to make a business decision and terminate someone for cause. We're not going to hold that against the business. So that's what this is doing here. And of course, if an employee voluntarily requests a reduction in hours, and we're using that metric to calculate FTEs, we're not going to hold it against the business. So a couple of very specific items that can come into play, and importantly so that they make exceptions for these items. More importantly, Tom, is this safe harbor. FTE safe harbor number one. Also something that many of you may see if you're looking at utilizing the easy loan forgiveness application. Exactly the same verbiage. Noting that to use the easy loan forgiveness application, this is one of a two-part criteria. So you'll see the same language, it applies the same way. It may get you to the easy loan forgiveness application, or may just get out of the fact that any changes in your workforce impact forgiveness at all. In a nutshell, what this is saying was, did the level of business activity decline after February 15th of 2020 as a result of the business having to comply with requirements or recommendations for COVID that were set forth by CDC or OSHA or HHS? Pretty broad. A lot of things to think about as we think about how that may have impacted our businesses. Something to think about. I'm not going to say definitively should anybody meet the safe harbor or not. That's something you need to really think about. Evaluate, can we document it? Do we have the information to support it? And is this the right path for us? But I certainly would not be taking off the table an ability to have fundraising events. That's critical to some of these, many of you, I'm sure, are nodding your head at this particular time, despite the fact that I can't see you on camera. But that's a very important aspect for many not-for-profit organizations. And having to comply with some of these requirements meant we weren't having fundraising events, or we were having them virtually. Some may have been more successful than others, but in many cases that led to a decline in the level of business activity, which is never really defined, but the SBA does suggest that the supporting documentation for that is financial records. So if I can show that I've had declines in revenue, and some of that's a result of having to comply with these COVID-related restrictions that were in place throughout 2020, and God forbid we don't see too many of them come back in 2021, that's something I'm looking at here. That was impactful to my ability to run my operation. And what this is really intended to do is say, if that happened, we're not going to penalize you if you couldn't maintain your workforce, right? You lost revenue, and we want you to keep everybody on payroll. There's only so many ways and so far that dollar will stretch. This is how that is alleviated, is this FTE reduction safe harbor. I'm using fundraising events as an example, something to consider, but depending on the activities your business engages in and how you were restricted, there's probably others that may be at play when evaluating the safe harbor. But I'm always starting here. Do I meet this criteria? Because all that FTE information Tom told me, I'd love not to have to think about it. There's also a second safe harbor that comes into play here on the next slide. This one's all math. And unfortunately, you do have to go through everything Tom just suggested when you think about how to calculate FTEs. This one looks a little bit different for PPP1 than it does for PPP2. In all cases, we start at the same place. And this is really looked at as a restoration of a workforce. It all starts with the measurement of the period February 15th to April 26th of 2020. If I look at my average full-time equivalents during that period of time, did it go down to the pay period inclusive of February 15th of 2020? Can I show a reduction? If the answer is yes, continue exploring. If it was exactly the same or there was an increase, you can't even look at the safe harbor any further. But let's assume that it did decrease during that period of time. Again, for PPP 1 or 2, we're still looking at a decline during February 15th, 2020 to April 26th, 2020. The question now becomes, did I restore my workforce levels? And by when? If we're looking at a 2020 PPP loan, that restoration date, that measurement date is December 31st, 2020. And what I'm looking for is my FTE levels at that time achieve or exceed the level of my full-time equivalents at February 15th, effectively pre-pandemic. You see that date referenced a couple of times throughout the course of the program. For 2021 PPP loans, that subsequent measurement date is the end of your covered period, right? Again, as Tom told us early on in the presentation, that can be any time between 8 and 24 weeks from the day you receive your funds. This may be a very strategic and intentional decision as to when you end your covered period if you're utilizing this safe harbor. Tom, I don't know that we see this one very often, but it's certainly come up. It's worth mentioning. But by all means, if I haven't been clear, please explore FTE safe harbor number 1 first before you go anywhere down the FTE path. That's always step number 1. Tom, factor number 3 here is salary and hourly wage reduction. This is effectively the other part of getting to the easy loan forgiveness application, or could be one of the other parts. What's important here, and we'll go through this one more quickly because we just simply have rarely seen this out of the thousands of businesses we've talked to over the last year and a half. Essentially, what this is evaluating is, did we reduce the salary or hourly wage rate, not total compensation, the rate of pay, by more than 25%? Noting we're excluding anyone who was already making over $100,000 in 2019. To make this determination, what we're looking at is the covered period. What's the average rate of pay, right? If I was paying Tom $15 an hour, I'm looking at $15 an hour, not times how many hours was he working. Average rate of pay over the covered period as compared to the average rate of pay for the most recent full calendar quarter before you received your PPP loan. If the change was not more than 25%, there's nothing further to consider here. That's what this analysis is honing in on. Tom, there's a safe harbor here as well. Looks very similar to the FTE restoration safe harbor. I think we could probably skip to the next one. I've covered that one quickly. The safe harbor here, same idea. Did I reduce the salary hourly wage rates of employees between February 15th and April 26th? And then did I restore them by either December 31, 2020 for 2020 PPP loans, or by the end of the covered period for our 2021 PPP loans? Again, we simply just don't see this one a lot, at least not in practice through this point in time. As a reminder, that factor number 2 and number 3 does not apply if the PPP loan was $50,000 or less. Tom, factor number 4 goes back to that non-payroll cost concept. I'll turn this one back over to you here.
Yeah, absolutely. Absolutely, Justin. So it's important to remember that there's a 60-40 split on this. A minimum of 60% of your loan must be covered using payroll costs, with a maximum of 40% being for the other covered costs that we've discussed today. Pretty easy. Just take your total eligible payroll costs, divide them by 0.6. If eligible payroll costs divided by 0.6 is less than total expenditures on payroll and non-payroll costs, then adjustment needs to be considered. Moving on to the timing of PPP loan forgiveness. How long does this take? So submitting your loan forgiveness application to your lender, you can submit it at any time before the maturity date of your loan. So, if you're in the situation where you're coming up on your first payment, you can still get full loan forgiveness. You can apply for loan forgiveness at any time, including before the end of your cover period, if you meet certain thresholds. So the review of the loan forgiveness application, and this is really the timing that needs to be thought about. A lender has 60 days from the receipt of a complete application. Yes, it has to be complete. Every time they kick back the application to you because you may have missed something, that restarts the 60-day clock. So 60 days from a complete application, they have to issue a decision regarding forgiveness to the SBA. The SBA then will remit the forgiveness amounts to lenders, plus any accrued interest through the date of payment, not later than 90 days after the lender issues its decision to the SBA. So really, this process at a maximum takes 150 days from complete application to receiving full loan forgiveness. Moving on to the unforgiven portion of PPP proceeds. What do you have for a loan in the event that you don't get the full loan forgiveness? 2-year term and 1% interest is on any loan that was approved prior to July 5th, 2020. But borrowers and lenders can mutually agree to extend the maturity date. It has to be a mutual decision to be able to do that. Any loan that was approved after June 15th, 2020 has a 5-year term and a 1% interest rate. Important to note, and this is more on PPP Loan 2 at this point because we're seeing payments on round 1. Payments are deferred to the earlier of the SBA remitting loan forgiveness funds to its lender or 10 months from the cover period. What does that mean? It means regardless of how long a cover period you pick, you have 10 months from the end of your 24-week cover period, assumed 24-week cover period, before payments must start being made. Okay. If the SBA determines that the loan was not eligible for forgiveness, whether it's in whole or in part, payments are no longer deferred. Also important to note that there are no prepayment penalties on loans. So you can prepay, if you end up in a position where you're repaying your PPP loan, you can repay it at any time without penalty. Justin, turn it over to you for some closing remarks.
Sure, thanks, Tom. And I was hopefully just caught up on a couple of the questions that were coming up. I see one more. Please send them in now, and I'll answer them. I'll just recap the couple I responded to. Health insurance, health, life, dental, vision, and disability. The employer's portion is included as a component of payroll costs. You cannot prepay those costs and include them in a forgiveness request, but as they're incurred and paid naturally, they are included as a component of payroll costs. The one that just came in about accelerated retirement benefits. You can't prepay retirement benefits. What came into play and where that comes up, and a clear distinction here is, let's say we've got a retirement plan that we fund a year in arrears, right? We do our profit sharing plan or a 401k match of some kind. It's probably more appropriate for this particular group. And maybe that's a 403b plan that we're contributing to. We may take all of, let's say, 2019 and make that contribution during our covered period in 2020, right? That's paid in arrears. That's okay. What the SBA wanted to come at and after an address, as there were less restrictions and we were looking at, and businesses were looking and saying, if I paid it during the covered period, I'm good, right? So businesses started looking and saying, well, what's going to be my share of retirement plan funding as a business for the year? And writing these big checks to go ahead and fund retirement plans during their covered period. That's what the SBA is precluding. You cannot prepay future weeks, months, etc. of retirement benefits and then include them in your loan forgiveness request. And then a great comment that was made for those of you that are evaluating the employee retention credit. If you don't know what that is, please look it up. It is a refundable payroll tax credit. Rarely do we get tax credits that not-for-profits can take advantage of. This is one of them. The employee retention credit, refundable payroll tax credit. Refundable also, yes, that means that the IRS will send you a check. And one of the things to keep in mind, and I think Tom mentioned it earlier, was that we cannot utilize the same wages to get to forgiveness as we do to claim credit. credits under the employee retention credit. One of those strategies, you think about the non-payroll costs, you think about covered period lengths, is how do I find a way to maximize the utilization of my wages between the two programs to maximize my benefits? Tom, we could spend at least an hour going through that conversation. We'll have to do that another day, but I did want to bring that up because it was a great comment that was made about utilizing non-payroll costs to preserve wages for ERC. It's a great idea. We're doing it all the time with our clients. If you don't know what ERC is, again, that's the employee retention credit, and we strongly encourage you to at least take a look at it and see if it applies. It can be worth up to $5,000 per employee for 2020 and up to $7,000 per employee per quarter for all 4 quarters in 2021, subject to eligibility. Hopefully that gives you enough incentive to take a look. If anything in today's presentation triggered something in your mind that says, you know what, I need to reach out to Aprio, I bet they can help me get to forgiveness, or maybe it's the employee retention credit. You see the URL here on the screen. You're welcome to reach out to us and schedule a time to speak with one of our team members and understand more about how we can support you in undertaking that process. I believe we covered the questions on the board, but if you have any last ones, throw them in. But we certainly appreciate your time this afternoon, and hopefully this gave some clear insight and direction in how you approach and navigate the loan forgiveness process. And we appreciate your time. Emily, I'll turn it back over to you.
Tom, Justin, thank you so much. This is just a wealth of information, and we all have our homework to do now, right? You've given us lots to think about and work on and prepare. So thank you so much.